Investing doesn't have to be complicated or feel like it's reserved for the wealthy elite. Today I'm going to show you a simple, straightforward investment strategy that anyone in Australia or New Zealand can set up with two ETFs, the VAS fund and the VGS fund from Vanguard. Now, if you're feeling overwhelmed by investing, you are not alone. Many new investors get bogged down by trying to pick individual stocks or trying to time the market. But here is a little known secret. Even the pros struggle to beat the market consistently. The last time that professional investors beat a similar strategy to what I'm showing you today was all the way back in 2009. In this video, I'll be sharing how you can set up this two-fund strategy for your portfolio. Let's first start with the two funds themselves, VAS and VGS. These two acronyms represent two funds from the world's largest asset manager, Vanguard. If you're worried about how trustworthy they are, just know they have over $10 trillion under management. That's almost the same amount as it would take to buy the whole country of Australia. The VAS fund is the Australian Shares Index ETF. It includes the top 300 companies on the Australian Stock Exchange, giving you exposure to a broad slice of the Australian economy. Think of the big names like Commonwealth Bank, BHP, and Wesfarmers. Investing in VAS means that you're covered on the home front, but Australia makes up only about 2% of the global market. To round it out, we need global exposure, and that's where VGS comes in. VGS stands for the Vanguard International Shares Index ETF. It invests in over 1,400 companies from developed countries around the world, like the US, UK, Japan, and many others. Imagine having shares in giants like Apple, Microsoft, Amazon, Meta, all in one fund. Now, why does this two-fund strategy make sense? It's all about diversification. By investing in VAS, you're already covering the top companies in Australia. And with VGS, you get exposure to the best performing companies in the rest of the developed world. Essentially, you're diversifying across industries and regions, which reduces the risk of putting all your eggs in one basket. Another reason this two-fund approach works well is for simplicity. When your portfolio only has two ETFs, you don't have to worry about consistently researching individual stocks or stressing over market timing. Just invest in these consistently, which is also known as dollar cost averaging, and you're set to capture long-term market growth. Many trading platforms make this easy through auto-invest features. Our super funds are very similar, as every week we contribute into it and the money gets invested automatically. Next, let's talk about the fees. One reason ETFs like VAS and VGS are so popular is because they have super low management fees. VAS charges 0.07%, meaning you're only paying 70 cents for every $1,000 that you invest. VGS, being an international fund, is slightly higher at 0.18%, but that is still very affordable compared to traditional managed funds that can often charge 1% or more in annual fees. This might not sound like a lot, but over a working career, this can make a huge difference. If we make an average 8% return and contribute $100 a week from 20 years of age to 65, we'd have $2.1 million at 65. If our two-fund portfolio costs 0.15% a year, and the managed fund equivalent making the same returns charged 0.65% for example, our net annual return would drop to 7.5%. Our return at 65 would amount to $1.8 million, roughly $300,000 less than choosing the lower fee option. This is a simplistic example, but it illustrates the importance of minimizing fees. With a low-fee portfolio, you're keeping thousands of dollars that would have otherwise gone to management fees. This is money that stays invested and continues to grow. Let's now take a look at the historical fund performance. VAS has averaged an annual return of 8% over the past 5 years, while VGS has averaged 13% over the same time period. It's important to note these returns include both the capital gains and dividend reinvestment after fees. Returns can go up and down in the short term, but over the long term, these funds have been consistent performers, which is why the two-fund strategy can be such a powerful choice. Another thing to note is both funds are domiciled in Australia. This means they are taxed in Australia, making things easier to manage at tax time. In regards to franking credits, not all Australian companies offer fully franked dividends. This tends to fall between 60 and 90% in any given year. In 2024, this came to 78%. So that is something to consider with the Australian VAS fund. With the International VGS Fund, you might be concerned about the currency risk with investing abroad. Vanguard also offers a hedged version called the VGAD, which invests in the same companies, but they hedge away the exchange rate risk. Vanguard also allows you to set up a dividend reinvestment plan, which automatically reinvests any dividends, helping your portfolio compound over time. So, how much should you invest in each of these funds? Unfortunately, there is no one-size-fits-all answer. Many investors opt for a 70-30 split, with 70% in VGS and 30% in VAS, to reflect the largest share of global markets compared to Australia. Others prefer a 50-50 split or even 90% in VGS if they want to go large on international exposure. Ultimately, how you allocate should align with your goals and comfort level. A higher weighting towards VGS gives you more global exposure, while a higher VAS gives you more exposure to local companies. To invest in Vanguard funds, you'll need to find a broker. Sharesies and ASB Securities are a great option for New Zealand investors, as they offer direct access to the Australian stock market. In Australia, there are several options. Any trading Australian shares would work, such as Moomoo, CMC, and Tiger Brokers. CHESS sponsorship is important for some investors too, meaning that you directly own your own shares. The others are custodial, which means that it's held in their name, they just keep a record of who within their platform owns the proportion of shares. To put a spin on the two-fund portfolio, you could augment it with other fund options. Vanguard offers 27 other ETFs in Australia, each different from the other. Many investors like to de-risk their portfolio with an allocation towards fixed interest funds. Vanguard has 7 options which invest in government and corporate debt. Essentially, you're lending money to the government or to companies a bit like a bank. The returns do tend to be lower, and they are often deemed to be a lower risk investment with less price volatility. You also have options in the emerging market space like the VGE fund to increase your portfolio weighting towards companies in China, India, Brazil, and other emerging markets. Just be conscious the emerging markets tend to be riskier and carry higher management fees than VAS and VGS. For a simpler option, Vanguard even offers diversified ETFs similar to super funds. They're an all-in-one option with exposure to stocks and fixed income investments all over the world. Just remember, it comes with a preset allocation, so you won't have as much control over the balance of your investments. To sum everything up, VAS and VGS offer a simple, cost-effective, and diversified approach to investing in the stock market. Whether you are new to investing or just looking for an easy-to-manage strategy, this two-fund portfolio gives you access to both the Australian and global markets in a balanced way. If you found this video useful, I'd appreciate it if you subscribe to the channel. It helps me create more content just like this for free on YouTube. I also have an Instagram account at Brent Coleman Investing. I've been pretty useless at posting, but I hope to post more over there in the coming months. Thanks again for watching, and I look forward to catching you on the next one. Cheers.